Well, hello once again, Maverick Traders. It is Joe. It is time for a ThinkorSwim lab. We are moving through the basics. Here we are at the risk graph for options. This is a super exciting thing for you guys that are brand new to options and have yet to see this. Now, for the majority of people that have seen thousands and thousands and thousands of videos on this topic, here's another one. I'm going to go over the basic navigation, how to read the information. I'm going to get into combining an outlook using the stock chart and the options risk graph itself. This is actually in line with the progression of Maverick's philosophy, so it will get exciting towards the end. Now, guys, I do not work for ThinkorSwim, but I do use them a lot. They're a lot of fun, and their risk graphs are fabulous. So take responsibility for the outcome of whatever you decide to follow along with this. This is going to be example-based, and it's not going to be relevant by the time you get to this video. How's that for a disclaimer? Thanks for joining me, folks, and let's jump into the software. So I took the liberty of building a combo for this class. This is a vertical spread, a bull call spread, debit spread on STWD. You can see that it is at the default of one line plus expiration. That is the red line and the purple line. I'll get there in a second. Also, what I want to show you guys is the price slices, things we'll be talking about, these three lines. This is also the default, which we have the active stock price and then plus minus 10% on either area. And at the very bottom, you can see that that is the spread I chose. It's a 24.25 bull call spread, and it looks like it's going for about 40 cents. Now, as you're looking at these prices can change. So you might see that debit increase or decrease because this is a live market. And what's cool about this is this will update real time. What I want to first start with is the risk graph itself. So we have that nice red line that's got a flat edge, and then it's got a 45-degree angle and another flat edge. Guys, I'm going to have you reference the directional options course, Module 2, vertical spread. So if you guys have seen this already on a worksheet, then you should be privy to where we're at. This purple line is current. It is the gain loss, or I should say the risk graph for the 24.25 vertical spread currently. This can also change as we go. So how do we manipulate this, and what do we get out of it? Well, it's pretty easy. This is cursor involved. One thing I love about this software is all I have to do is move my mouse around. You can see I've got this finger up here, and I've got this vertical line, this white line that goes up and down. And what this will tell me is anytime I drop it or stop it at a certain area, real quick reference, folks, the numbers on the bottom from left to right is the stock price increasing, and if it goes left, it decreases. On the far left margin, we have gain loss. Up is gain, which you can see by the positive, and down is loss by the negative. So it's basically an XY axis. Now, if I drop my cursor, or I should say move my cursor and stop it anywhere along the line, let's say that I stop it here down at that 25 mark, you can see that I've got a potential gain to $27.70. That's if the stock goes up to 25 right now or today. Now, what's really cool is if you reference the bottom left side, I'm going to have you guys reference this a few times. I have in some of my previous classes as well. This will give us what to expect at expiration as well in the red area. It looks like it's about $56. Right? What it's basically going to be is the difference of the cost versus what is potential in the spread. So I'll get there in a second. All of this actually you should be able to reference in previous classes. So first thing I want to do is take a look at this over expiration cycles. Now, what I love about this, this is where I usually start with most of my analyzing most of my combos, is up here to the left. I'm going to pull down day step and at expiration. So I've got one, it'll draw two expiration dates, or three lines, I should say, 2 lines, 3 lines, or 4 lines. Now, what I try to do is get as close as I can from the expiration cycle. In this case, I think I'm about 29 days to the expiration price. And what do I mean by that? It just gives me that at expiration line. So in this case, I'm about 29 days to expiration, so I went 10-day step. You can select the day steps up here by increasing or decreasing. So 10 divided by 3 should give me all the way to about 30 days out, and you can see that this blue line is nice and square. Now, let's change this. What if I was to go ahead and choose a 4-day step and keep it at 10, or at 9, so on and so forth. You can see I've got this extra line here that goes flat. That's because I'm past the expiration cycle. Now, if you don't mind it, hey, that's great. I do. I want to get as close as I can to that expiration cycle. And you can see that if I drop down to 7-day step per 4 lines, I still don't get that right angle. Now, guys, that's a little OCD. Yeah, I apologize, but that's just kind of how I like it. So I will go to the 3-day step, and I will jump it down. Sorry, folks, 3-day step. And I'll jump it up to 10, and you can see I get that nice, really close to expiration line there. So what is this for? Well, it's a way to quickly gauge. Once again, I'm just going to move my cursor. I'm going to leave it at that $25 mark. I'm going to have you guys cast your mind down, or cast your eyes down to that far left, and you can see the dates all the way to the 17th. Expiration, I do believe in this, is the 16th or 17th of the month. So it starts from today, which is the 18th of August, and then it jumps 10 days, 28th, then the 7th, and then the 17th. Kind of cool. So it gives you an idea of what to expect if nothing changes. This is no change to volatility. This is basically just time decay at the current rate of what it's at all the way to its expiration cycle. So it gives you these ideas of what you'd expect in this moving forward. That's kind of the basic part. That's where I start. Now there's some other fun things that we can do. So I'm just going to go ahead and leave it on our day step, and I'm going to cast your eyes up to the top here. Now what we have is a market P&L. You could do this with P&L for the day, delta, gamma, theta. Once again, once you get into these, theta is a different type of graph, vega is a different type of graph, so on and so forth. We can get deeper into this in some other classes. For now, I'm just going to stick with good old profit loss. The next one over is the probabilities of in the money, which is default, out of the money, which is basically the inverse, and I'll show you this in a second, and touch, the probability of touch. A lot of traders like to see that, saying that, if I've got a debit spread or maybe one leg of an iron condor, it's interesting to know the probability of it actually getting and touching that level before I have to close one side or the other. So probability of touches is actually a pretty popular one. So I'm just going to stick within the money. Like I say, I might reference out of the money, which just flips it from basically a positive to a negative. And the next is our probability range over here to the right. Now this is set at 1 standard deviation, 68.27%. You could do 2, you could do 3 standard deviations. I like to stick to the 1, and the reason being is I rarely trade that far down to where 2 or 3 standard deviations become in my wheelhouse. I'm more of a 2-week, 3-week guy at most than I am longer term. This is preference. The next is increase or decrease dates. Now we're on the 18th, which is today, and so we've got this whole risk graph here, and you can see it's a nice gray color. If I click up one day, which is tomorrow, the majority of this turns black. And what I want you guys to focus on is this gray area right here in the middle. This is giving me the area or the range that expected based on the volatility of the underlying and its expiration cycle. Now it's pretty obvious to say that each time I click forward, here's 2 days, here's 3 days, here's 4 days, so on and so forth, this gray area widens. And what this does is expands the range of expected price action. So if I go 4 or 5 days, let's say I believe I'm about 5 days into this, I would expect a price range anywhere from $23.29 roughly to up to $24.61. That's all it's saying. So the ability for this to be somewhere in this range is going to be super high. Now here's the funny thing, because that's in the money. If I flip this, I told you I'd do this, to out of the money, it just reverses the spectrum. The idea that it's going to be inside this range is going to be the higher, and the outside is going to be the lower probability. So the expectations of it being outside of these marks have their related percentages as well. So it's just inverse. Let's go back to in the money. So you can continue to click this away, and it gets super fun, and it goes all the way to the expiration cycle. This can also give you an idea of, hey, after 4, 5, 6 days or 3 days, what's the range? Well, based on what we have here on the 29th of August, we'd expect a range anywhere from this lower end to this upper end. Now, obviously, we'd like the upper end because this is a bullish trade to the upside. But this is an expectation. Now, this might not be too big of a deal when it comes to kind of a set and forget vertical, especially in the debit side. But this might be super cool if you're playing something like a condor spread, or you're doing something on the credit side, bear put spread, or I should say a bear call spread, or a bull put spread. Anything on the credit side is coming kind of advantageous to know that the probabilities of it getting there. This is also where you could move over to touching, the probability of touch, and it's basically the same rate. It's the idea of, hey, how far can it go in this amount of time, the selected days, to where it could touch the upper or lower range. Pretty cool. So it's almost the same thing that you're looking at. Let me back this down to where we were for today. You can see it goes gray. And let's talk about these price slices. So the next thing I like to do is price slices. And to reference how I use these, I got to go to the chart. So I'm going to jump over to the chart. And there's a couple things I like to do with this. Now, I'm not going to get into a charting class, folks, because we've made many of them. However, this is one that I think is kind of nice to play with. We've done Fibonacci retracements. We know how those work. I'm going to go ahead and just do a rough one. I'm going to start with this bottom area. I'm just going to drop here, and I'm going to pull back to this previous pivot point. And now I've got areas where I think this stock could hit. This is kind of how I set the trade up in the first place. So I know that based on the first move and the retracement, these are the expected moves. Let me go ahead and shrink this down because I want to get it to 100%. And you can see I've got levels of 38.2% at 24. Oh, that's going to be easy, a little bit longer term. I like the standard deviation, 61.8%, or just shy of that as at 25, which is the strike price I selected. Some of you might want to go to the full move, saying that, hey, if it does exactly what it did back in this day, I'd expect to move up to $26.43. There's no wrong way to do it. This is one of the numbers that I came up with. So the 61.8% was at $25.14. I could actually place that or put that into my risk graph as a price slice. Let's do a different one before I get there because I want to show you one that I think is a little quicker, a little easier. Do I dare say lazier? No, not really, but it's kind of cool. I like this line. This is just a good old-fashioned trend line. I'm going to just click at the bottom here, left click once. I'm going to hold, drag it up, and I'm just going to drop my mouse here. And what's cool about this box to the left is it's giving me the days that it took to get there. 14 full days, but 11 bars. Why is that? Well, because there was a weekend in there. It is a 5.82% move from where I started the line to where it's sitting currently, which is $1.35 to the upside. Now, what's awesome about this, it just compares apples to apples in the situation to where, hey, if this had a $1.35 move in 14 days, how about 14 days from now? I could expect something very similar, $1.35 or maybe a 6% move, 5.82%. Once again, I can use these numbers as price slices and analyze combos with those set. What do I mean by what do I mean by that? Boy, that's a little bit of a babble. Well, let's go take a look at it. So here we are back on the analyze. I'm just going to go to the price slice here, change this to a percentage, and what do we say? It was going to get to 5.8%. We can drop it down to 6%. Let's get specific. Let's get exact. All right. You guys know my OCD, 5.88%. Let's try that one. All right, so it drops this thing at $25.41. We can analyze that. Looks like we are well shy of that. This combo should compensate for this nicely. What was the other one we took a look at? It was $1.35, and I don't have to show it to you, but I can show you that we can do it because it's going to be in the exact same spot. So I changed this over to $1. So let's just click it up. Usually it should work. There it is. So I changed it to $1.35, and there it is. It shows me exactly what to expect at that timeline. Now, what's really cool about this, once again, the default is plus minus 10%. By the way, a real quick cheat on this is to right-click anywhere in the price slice area and go to Reset Slices, and guess what it does? It knocks it back down to 3 values, or I should say 3 lines, plus 10%, 0, and minus 10%. Over on these choices, you could lock these at any time at a specific price. I'll show you the choices here. We've got deviation, standard deviations, and you could go to an offset anywhere from +3 to -3. You could jump this over to EPR, or expected price range. This is something that ThinkorSwim did specifically for this program, and it gives it ThinkorSwim's expected price range and offsets it by 0.5 increments. So plus or minus. And what I figured out, folks, I did a rough math on these, that 0.5% is actually, or 0.5 is actually 12.5%. So if you go from 0.5, it's 12.5%. 1% becomes 25%. 1.5 is, you get it, 38.5%, so on and so forth. That's a rough estimate. But other than that, you could probably get online with them and get the exact breakdown of it. And then good old percentage. So however you want to see it. Another thing that's really cool about there are some presets here. You can go to row count, so I can put in, defaults at 3. I could do 1, I could do 7, I could do whatever. I could go to set slices, and this will give me all sorts of different things. Here's one that's going to give me a plus minus 3 standard deviations. Here's one that does plus 1 minus 1. Here's dollar increments. Here's interesting. Here's 7 rows at 5% increments. So I click on this. It gives me from 0, 5, 10, 15% up, and it's giving me -5, -10, -15% down, and other price slices there. So kind of cool. You can also click, drag, and hold these. Click and hold and drag, I should say, and drop them anywhere you want based on what you want to see. Now, what's really cool about these is once you set them up, you can come back and reanalyze the trade if you've got it already, or let's say that you're comparing a few of these. So if you're comparing a few of these trades together, it might be easier to just kind of bounce back and forth in what you have. Let me go ahead and go back to reset the slices here. So right now I've got a vertical spread. Let's go ahead and add just a straight call. Let's say, what about the straight $24 call? How about something a little deeper in the money, get aggressive? I'm going to go ahead and buy the 23. You can see it's added here. Let's just go back to the risk profile. Now, folks, you have to deselect what you're looking at and what you don't want to look at. So I'm going to go ahead and just select the straight call. This is already stepped by 10 days. You can see I've got my expiration. It's the same exact same thing, except this is just a call. Analyze it any way you want. I've got my price slices set at 0 and plus minus 10%. You click, drag, hold, do whatever you want, and analyze it from there. All right, folks, like I say, not too big of a deal when it comes to, hey, Joe, tell me something I don't know. You probably already know this, but it's just the way that I like to use it, and bouncing back and forth and drawing those lines, getting the percentages or the Fibonacci's. It's kind of neat to snap back, use these price slices, and get an idea of what you could expect moving forward, and also base it on the probability of it. In this case, touching in the money, where it lies on a standard deviation probability range per day. There's all sorts of different things you can do with this. All right, get out there and play with it, folks. Thanks for joining me, and we'll talk to you next time. Bye-bye, everyone.